I want to thank everyone for joining us for what most consider to be the most exciting event in December, holiday season included, which is tax planning considerations with HKA. My name is Jordan Kuhlengel. I am a partner here at Hawk Cruising Associates, and I have a panel of people with me, which I will let introduce themselves.
I am Jake Shockley. I am a tax manager here at Hawk Cruising. I've been here for 7 years, and I'm an enrolled agent and an ARA.
My name is Elisa Baker. I am a business team associate and I have been with Hawk Cruising Associates for 2 years.
I'm Damon Washington. I am a CPA. I have been with HKA for 6 spectacular months, and I'm a tax senior at the company.
Great. We'll let you introduce yourself, Kelsey.
Yeah, my name is Kelsey Cutoff. I have been with HKA for 2 whole days, so it's very exciting so far, yes.
Awesome. Very excited to have you. And my name is Catherine Cruzy. I'm the client service manager at HKA, and my job today is to make sure that your questions get answered. So if you have any questions that you want to be sure are answered, you have a couple different ways to do that. First, you can send me a direct chat through Zoom, and you can also send me a question using the question and answer button at the bottom of your screen. And then I will make sure that your questions are answered.
Great.
Okay.
So today's webinar will be divided into 2 sections. The first section will be tailored towards individuals, common year-end questions we receive, maybe some charitable giving strategies, and then also an update on some recent law changes. The second section will be tailored towards businesses. We'll be talking about the SALT election and once again, common year and wrap-up items. If anything that you see here isn't covered, but you still want to know about it, you are more than welcome to chat in with any questions you have. Great. So the first thing that we're going to be talking about is a very common topic of discussion we have with clients at the end of the year, which is charitable giving strategies. So to start off kind of at the basic level, there are different ways that you can donate to charity. So the first method of doing that is cash to a not-for-profit organization. What does cash mean? It means you can give actual cash or checks, obviously. Another common one this time of year is maybe we're cleaning out the house. We find out that we don't need this 3-year-old coat anymore that, is still perfectly good. We want to donate it to Goodwill or an organization such as that. You're able to donate those household goods to, once again, not-for-profit foundations and receive a charitable deduction for them. Another option is appreciated assets. What that means is we are giving maybe stocks that have appreciated in value since we purchased them and donating those directly to charity. And then the last one that we can do is qualified charitable distributions, which is I have an IRA and I'm at the R&D age, and rather than taking the cash and donating it to charity, I will simply meet in the middle and have my IRA donate directly to charity. Now, each of these have different levels of deductibility. So at the end of the day, most people can deduct the entirety of their contributions. If you are donating a lot in one year, you may be subject to limitations based off of your adjusted gross income. So cash would have a limitation of 60%. Household goods, same. Appreciated assets such as stock, you will have a 30% limitation. The benefit of the appreciated assets is that rather than liquidating a stock to provide yourself cash to donate to a charity, what you can do is simply donate that stock directly to the charity. You avoid the capital gains, and then you're able to write off the fair value of that asset at the time of donation. And then lastly, qualified charitable distributions. This is a situation that you'll see commonly with people who maybe aren't itemizing, but they are subject to R&Ds. They have extra cash, they give to charity. Using a qualified charitable distribution out of your IRA means that that money that's coming out of the IRA is not entering your taxable income pool and is rather just not being included. So it's essentially a write-off. It's a little bit different, but at the end of the day, that's the same. Some potential modifications that people can do when we're talking about how to maybe donate more efficiently. So for example, bunching. So let's say I am donating $10,000 to charity every single year. and I still don't cross that itemized deduction threshold, I'm not receiving any tax benefit to it. Obviously, there's a social benefit. So one thing that you can do is called charitable bunching, which is if your not-for-profit, still has a need and maybe you want to put 2 years worth of donations in the same period so that you cross that itemized deduction threshold, you get the benefit, and then you still have the standard deduction the next year whenever you've decreased your contribution. So, at the end of the day, it's a tax saving strategy. A lot of times, people are personally involved with their charities, their churches, whatever it is. It doesn't work for everyone. It is a tax strategy. It's not necessarily something that everyone wants to do, because some people want to give regularly to their church, to whatever. So, feel free to talk about it with the not-for-profit you work with to see if that's gonna harm them in any way. At the end of the day, it may work tax-wise, but may not work for you on a personal level. But certainly worth exploring regardless, I think. Another thing people will do is donor advised funds, so maybe you have an influx of cash, I want to be more charitably inclined this year because I've been blessed, so I want to then distribute that to others, but I don't know exactly what I want to do yet. Donor advised funds are an excellent tool for that, where essentially at a financial advising firm, what you're able to do is take that money and then fund this donor advised fund. You receive a deduction at that time. That donor advised fund can sit there, and as you figure out what you want the money to go towards, you're able to then deduct those or provide essentially grants to public charities. And you don't receive a deduction at the time the money actually moves out, but you did receive it at the time it was funded. So it's an excellent tool for, I know I want to be charitable, I need a tax deduction this year maybe. This is a great option. Only thing to be careful about with donor advised funds are it has to be a public charity. So if you are working with private foundations and you're thinking a lot of money might go towards that, it may not be a great tool for you. But for most people, most of their charitable giving is normally tailored towards public charities. So it typically works at the end of the day. And then lastly is focusing on charities with tax credits. So this is people, once again, who maybe don't have as personal of a connection with a charity, but they know they want to be charitable to society as a whole. And they're thinking, I want to get the most bang for my buck. Lots of states offer tax credits associated with charities. So domestic violence credit is one in the state of Missouri, where if I donate $1,000, I receive a 70% tax credit with the state of Missouri, which means that's dollar for dollar offset of $700 at the Missouri state tax level. And then I still receive a charitable deduction for that remaining $300 on my federal return. So if you're looking for the most bang for your buck in terms of charitable giving, and you're still wanting to do that, that's a great option as well. Catherine, do we have any questions? Panel, did I miss anything?
I don't believe you did. No.
We don't have any questions at this time, but just a reminder, if you would like to send something, you can click on the question and answer button at the bottom of your page, or you can send me a chat and I will make sure that Jordan gets it answered.
Yes. Great. Jake, will you be taking this one today, or will it be me?
I'll take it. So a lot of things that happen, a lot of conversations that happen at the end of the year is families want to gift more to their family members, their daughters, grandchildren. And a lot of the questions that we get are, is this a tax consequence for me or my children? And the answer to that is no. There is something called the lifetime exemption, and right now that is $12 million. And so if you gift more over your lifetime than that, then you might run into tax, but right now it is not a tax consequence. And in 2023, the gifting limit is $17,000 per person per taxpayer. So you can give your child or grandchild $17,000 and nothing needs to be reported. Nothing is taxable to them. And so there's a multitude of different things that you can do with gifting. You can give straight up cash to the child or grandchild. There is retirement plan place or replacement. A lot of people, what they do is, let's say they have a 16-year-old that has a 401k that they can contribute to, and at that time they might not be focusing on retirement because they're just now getting a job. You
Right,
can
you need that Game Boy money.
yes, exactly. So the grandchild then or the grandparent might tell them, hey, we'll fund your lifestyle for the next month or so. So then you can take all of your earnings and contribute to the 401k. or an IRA. And the next would be 529 plan funding. A lot of grandparents start funding education for their grandkids to help, kickstart that education for college right now. And then you can also do 5 years of 529 plan funding. You still have to file what's called a gift tax return, but it does not lower that lifetime exemption.
How,
So Jake, in these examples, for example, you have a 2023 limit of $17,000, but then you also talked about a lifetime limit of around 12 to $13 million. So let's say this year I give my niece $17,500. What does that mean? Does that mean I pay tax on $500, or what happens with that?
So what will happen is, you'll have to file what's called a gift return, it's a form 709. On the return, you'll say that you gave 17,500. You'll have the exemption of $17,000, and it'll say, say quotations, it's not taxable, it'll say taxable gift of $500. And then you'll have on the line, you'll see $12 million lifetime exemption, and it just lowers that from $12 million to 11,999,500. So it just lowers that over your lifetime. And if you exceed that, that is when you start paying taxes at about 40%.
can you talk about like if you are married, how does that affect the gifting? Or if your grandchildren are married?
So
how
there's
does that change?
two different things that can be done. So my wife and I want to give my child $34,000 because my child will be receiving 17 from me, 17 from my wife. There won't be any gift requirement there. But if they give more than $34,001, then there is a gift reporting requirement. And so let's say I want to give more than that, and my child is married, I can give 17,000 to my daughter, 17,000 to their husband. Then my wife can give 17,000 to my daughter, and then 17,000 to their husband, up to $68,000. None of it needs to be reported, and once you go over that $68,000, that is when a gift tax return will need to be filed.
Right. And then on so just to rewind a little bit, so on the 529 plan funding, it's still the same annual exclusion limits of $17,000. A 529 plan, for those who don't know, is essentially a plan that you can put money aside, receive normally a state tax deduction, which that has some benefit, yes, but what happens is the money in that plan grows tax-free. And so long as it's used for qualified education expenses, when it's taken out, you don't ever pay taxes on that growth. So once again, it's a great tool for, I don't need this money, I want my grandkid to have it, but also like, I don't know, a young Jordan Kuhlengel with $17,000 wasn't gonna use it wisely, so maybe putting money into a 529 plan is a great option there. There's also, so let's say there's a scenario where a lot of people are probably aware that the estate tax is set to expire in 2 years, roughly 2 years. And it's supposedly gonna go down. We'll see what happens with laws passed, things along those lines. But let's say I wanna get a lot more money out and I really like this 529 plan funding idea. And also my kid's going to school or my grandkids going to school in 2 years. So what can I do there? There is an option to what's called super fund it, where you essentially take 5 years worth of contributions, lump it all into 1 year. You're able to exclude the entirety of that still from your lifetime exemption. So even if you gave, we're not gonna do the 85,000 contributions in 1 year, it's not going to reduce your lifetime exemption of 12 million because there's just this very specific rule that allows for this. Any questions on the gifting before we move on to accelerating income?
No questions right now.
Great, so accelerating income, probably a little bit counterintuitive to a lot of people. Why would I want to pay more taxes? There are situations where it can be beneficial to accelerate income into a current year. So let's say I am at the end of my career, my social security hasn't started, I don't have RMDs, and I've amassed enough wealth from my limestone fortune that I don't have to actually pull out of anything other than the cash I have set aside. In those scenarios, I have all of these unused lower tax brackets that are not being utilized, the 10s, everything below the 37 essentially. And in the years that I have RMDs, it's obviously gonna fill those lower tax brackets. So what it does is it provides you an opportunity. I have 5 years to use these lower tax brackets. Maybe I do Roth conversions. I take that money. It's a Roth conversion. I still don't need it, so I'm not gonna take RMDs on it. And maybe that's my money that I've set aside for the next generation that they can receive tax-free. It's a wonderful estate planning tool. It makes sense tax-wise because you're going to be paying higher income tax rates. And also, if you think about it then to the next level of, well, then my kids will pay taxes on it if I don't convert it. It's likely that they'll have jobs at that time and that they will also be already filling up those lower tax brackets. So everyone has different opinions on it. It's worth a conversation, very common topic of conversation we have with people's financial advisors and them as a client. So happy to walk through that with you if you'd like to discuss it further. Another thing, and this is gonna be mostly tailored towards your guys' financial advisors, is realizing capital losses. So market volatility has been higher in the last couple of years. There's a lot of opportunity for realizing unrealized loss positions. It's worth having a conversation with your financial advisor if it makes sense in your investment plan, maybe realizing those capital losses to offset future capital gains. At the end of the day, let's say I have no capital gains and $100,000 of capital losses. What happens if I realize those losses? I'll be able to offset any capital gains I have and then ordinary income up to $3,000. That remaining $97,000 of loss in this scenario, what happens to that? I don't lose it. It just rolls forward to offset future capital gains. So if you have normal, I'll call it ordinary income periods, or if you have high capital gain periods and you have the ability to realize losses, a lot of times it's a good strategy, but there may be a reason not to. Once again, your financial advisor is the expert in terms of when to sell positions. Maybe you're holding on to it for a reason, but once again, it's worth a conversation. And then lastly, my favorite topic of conversation on this slide is the manipulation of my tax brackets. So we're going into Christmas, Damon, and I say, Damon, I have a bonus for you. And the thought that crosses your head is, I'm not gonna take it because it's gonna put me in the next tax bracket. It'll cost me money. Is that how that works?
No, that is not how that works. So let's say that bonus was $1,000. It's not gonna cost me $2,000 in tax because I got an extra $1,000 in a bonus, even though, or we can even do that 12% tax bracket and it pushes you up to the 22% tax bracket. Only that $1,000 additional, let's just say you were right on the edge, only that $1,000 is gonna be taxed at that 22% tax rate. Everything else that you already earned is gonna be taxed at those lower rates.
That's correct. It's a common misconception of the way that income taxes work is that as I cross into the threshold of the higher tax bracket, all of a sudden the entirety of my income is now subject to this new rate. That is not the way that it works. It's a graduated system. So if you or anyone you know has said, I'm a genius because I turned away a tax or a bonus so that I avoided tax brackets, reconsider those choices, maybe reconsider those friends, I don't know. All right, so these are kind of the more recent tax laws that have come up, specifically last year and some things this year. One of them is focused around 401ks. So something that's new is traditionally whenever I contributed to kind of your standard 401k plan, normally there's gonna be an employer matching piece. Let's call it 4%. Historically, that has been required to be a standard 401k contribution. It's not a Roth style, it is a standard. There is an option now where an employer can do a Roth match, which means that it grows tax-free forever. You will pay taxes on your employer's Roth match, which is never happened before, obviously, since this is a new law, but it'll be an employer by employer basis who offers it. But it's certainly worth a conversation. If you are heavy in the favoring Roth field, this is a great option for you. If you are, I want the current tax deduction, this probably doesn't matter to you. It's not a requirement, it's an option at the end of the day. Something else that's also new is that starting in 2026, catch-up contributions are required to be in Roth. So for those who don't know what a catch-up contribution is, once you've exceeded a certain age threshold, you're able to contribute extra money into your retirement plans. Historically, That could be whatever you wanted, traditional or Roth. The IRS has come up with a rule where essentially it has to be Roth. The reason behind that would be in theory that they need tax revenue at the end of the day, and not allowing a traditional 401k catch-up contribution means that people can't avoid 5 to 7k of catch-up contributions in their taxes.
This is only for 401ks, right? Not not IRAs.
I'm not sure, to be honest. I knew it was for 401ks. I'm not sure about IRAs. Jake, you wanna talk about? No, you talk about the home energy credit. I talk about the clean vehicle credit. Excellent. Something else that's new is there's been some additional incentives to purchase what is called clean vehicles. Clean vehicles does not mean we run it through a car wash X number of times, I get a $7,500 tax credit. It means that it is traditionally an electric powered vehicle. There are all sorts of rules in place that stipulates what qualifies for this credit. I would make it my recommendation to talk to your auto dealership about it, because I'm sure that they know whether or not it qualifies for the credit. There's 2 different parts to it, but you can get a credit of up to $7,500. One thing to be careful of is your modified adjusted gross income has to be under $300,000 in order to qualify for the credit. So even if you buy this fantastic electric vehicle that has a $7,500 tax credit, make sure that you're actually qualified to take that credit. And that is a very simple phone call with HKA. What's my AGI if I buy this vehicle? Is it actually going to benefit me the way I think? So yeah, Jake, do you want to talk about home energy credits?
Yeah, so for 2023, there are 2 changes to the energy credits for your house. So the first one is just the energy efficient home improvement credit. These are more for the more minor improvements you might be having with your home, like windows, doors. So there's 2 parts of it to the home improvement credit. The first part is if you are replacing, windows and doors, that's a $1,200 credit or 30% of your cost, whichever one is bigger. And then you have a $2,000 credit for installing heat pumps and stoves and boilers. And that one's either 30% of your cost or $2,000, whichever one is bigger, or up to 2,000. And then there's the second one, which is the residential clean energy tax credit. This is more of a major home improvement. This is the solar panels, the geothermal power and the wind power, getting fuel cell batteries and charging ports for it. This is going to be 30% of your entire cost. There is no cap for it, and there's also no lifetime cap right now, and that's for the next 10 years. Both are non-refundable credits, and if you are doing these credits, all we'll need is the invoice from the builder saying how much you spent on these.
Right, and then our last item here is that there is a new rule in place for 529 plans, which we talked about earlier. Let's say your kid goes to college, they have extra money left over, or what do I do with that? There's a new rule that allows you to take up to $35,000 for a beneficiary and roll it into a Roth account. It's $35,000 lifetime limit per beneficiary. The rules are that beneficiary has to have been listed on the account for, I believe it's 15 years. And then you can slowly convert that balance over to a Roth IRA. It's a great way to start them out on a retirement plan post-college, and a great way for $35,000 to have compound interest for what you could assume would be a 30 to 40-year career, tax-free.
No questions at this time.
Excellent. Our next section is businesses.
So if you are on the webinar right now as an individual who does not have an affiliation with businesses, if you have any further questions, we'd be happy to take them before you hop off. But otherwise, this part of the webinar is specifically for small business owners.
Correct.
I don't see any questions.
Excellent. All right, something that has been sweeping the nation in the last several years is called the SALT workaround, also known as the pass-through entity tax workaround. For those who don't know, what happened back in 2017 was they put a $10,000 cap on your state and local income taxes, real estate taxes, and personal property taxes on your individual return. So that means that if I have real estate taxes of $8,000 and I work in the state of Missouri and I make $1 million, so my state taxes are roughly $50,000, I get to deduct almost none of that at the end of the day. What happened is that state by state throughout the country, they started implementing these SALT workarounds where small business owners are able to make an election at the entity level that will have state income taxes that would be assessed on owners, actually assessed at the entity level. Entity then pays it and receives a current tax deduction for it. It's basically implemented in most states that have, I believe it's all states that have state income taxes at this point. It's a case by case basis on who it benefits. So it's not an automatically, this works for everybody. Certain income qualifies for it, once again, on a state by state basis, because this is not an IRS rule. We're technically dealing with roughly, I believe, 38 different variations of this state election. So it's worth a conversation with your CPA, with us. We're happy to kind of walk through it with you and tell you whether or not it would benefit you. Any questions?
No questions.
Great. Another common item that I come up on at the end of the year is people looking for some sort of tax mitigation, maybe through capital asset purchases. So one of the main things that I like to try to drive home in these conversations is, Elisa, let's say I buy a grain auger for $50,000. Is that ever gonna save me $50,000 in income taxes?
No.
No, it will not. Everyone has an effective rate that they're paying taxes at, so best case scenario, I will save roughly half the value of that grain auger at the end of the day. So you're never going to make money by doing these year-end purchases. What you are doing is taking maybe some money that you would pay to the government and instead allocating it towards something that hopefully you need or will grow your business. I always try to drive home, there should be some sort of business use to the things you're buying. You're never gonna save money by just buying things to buy them to reduce taxes. You will still be out of pocket more money at the end of the day. So if you're considering this, make sure it's something you need, something that'll help grow your business, optimize your business, make it more efficient. Things along those lines, or something that will make you enjoy your business more. I don't know. Let's say, you have a truck currently and you hate it, but you need a truck for your business. Great, buy a truck, make sure it's one that works for your business, you'll get a write-off for it. Just once again, make sure there's a real business use there. The next bullet point would be managing cash inflows and outflows. So most small business taxpayers are what's called a cash basis taxpayer. That means as I receive money, I'm paying taxes on it versus whenever I earn it. So if my job is installing putting greens, and let's say I receive a cash payment up front under cash basis taxpayer. I haven't earned that money yet because I haven't installed it, but I do have to declare it as income because I've received payment for my work. Under accrual basis, you wait until you've actually performed the work in order to actually recognize the revenue. I would say 90% of small businesses are cash basis taxpayers, which means that they have an opportunity to manage the cash inflows and outflows of the business in order to somewhat, won't say manipulate because that sounds like an incorrect way of doing things, but have the ability to manage their cash inflows and outflows at the end of the year to help control their taxes at the end of the day. Common strategies for that are purchasing inventory, delaying revenue. So doing those things is kind of it will be a one-time timing benefit that you will likely continue to do the same sort of strategy on a year-by-year basis. It's unlikely that you'll pre-purchase a bunch of inventory in 1 year and then not do it the next year because you'll still want that deduction the next year, more than likely. The only thing to be careful of is making sure that you're not driving yourself into the lowest brackets or driving yourself out of the lower brackets to then have more income subject to the higher brackets. So if I would traditionally make $200,000 per year pretty steadily, and I can manipulate it to be 0 1 year, but that will result in being $400,000 of income next year. At the end of the day, averages say that I'll pay more in income taxes as a whole because I've had more income in these higher tax brackets versus filling up these lower ones at the end of the day. A great question that we get from lots of new business owners is, how much money should I take out of the company? So let's say I'm running my jam making business. We have all sorts of different businesses going today. I'm making my running my jam making business. Catherine and I have obviously done very well at it, and we have a profit of $350,000 per year. And we're wondering to ourselves, well, how much money can we take out? Because I don't want to be double taxed on it. I don't want to take it out and pay taxes on it and pay taxes on it at the N2 level. Once again, 99% of small businesses are not C corps, which means that whether you take the money out of the company or leave it in, doesn't matter at the end of the day. The IRS will tax the profitability of the company. The cash you take out of it at the end of the day shouldn't have a real tax impact. There are caveats for things like basis, which is a more nuanced discussion, which I'm happy to have with anyone on this webinar or anyone who has questions about it. But at the end of the day, as a general concept, you should not be concerned about double taxation, increased taxation on leaving money in a company versus taking it out. Another thing that people can do towards the end of the year is maybe they're hosting corporate retreats. They have a lake house out at Lake of the Ozarks. It's a great house, very popular with a new show that recently ended. Life is good. The question is, can the company pay me for use of my personal property? And almost inherently you kind of think, oh, I don't know, that sounds a little gray area. It's actually not. There is a specific rule in place called the Augusta rule where, number one, a company can pay rent to anything for reasonable use and rates. So if we're hosting a corporate retreat at a lake house, what does a lake house typically rent there for a couple days? Very reasonable for a company to pay the personal owner that amount in order to utilize their property. Okay, well then I would pay taxes on the other side in theory. The Augusta rule specifically says if you rent out a property for less than 14 days per year, you're not required to report that income. The Augusta rule is called the Augusta rule because of specifically the Masters golf tournament, where the people of Augusta, Georgia somehow lobbied the local government that I'm sure turned into state and federal government into this tax law that specifically allows you to exclude 14 days of rental income. Because guess what? Most of the people in that area probably rent their house out less than 14 days for the Masters tournament, which is roughly 4 days plus a couple days of practice round. The last item on the agenda is this new fun FinCEN reporting requirement. So beneficial owner information report is a new rule put in place by FinCEN. It starts January 1st, 2025 or 2024 for new companies. Where basically you're having to register common information. I believe the intent behind it is for anti-money laundering purposes. But at the end of the day, what's going to happen is each operating business that is registered with the Secretary of State, that includes some exceptions of roughly 25 to 28 styles of companies, such as accounting firms, will have to register with FinCEN, where they list fairly standard information at the end of the day. It'll be, this is the entity's name, address, EIN, who owns it, those people's address, social security numbers, forms of identification, things along those lines. The important thing to remember is that new companies have to do it within, I believe it's 90 days at this point. They changed the rules on that. So within 90 days of formation, they have to register with FinCEN. Existing companies that are in place at this point already, they have to file by January 1st of not this next year in a couple weeks, as in a year beyond that. It's a service we'll be offering to our clients. I don't have a ton of information about it at this point. Beyond that, they're still releasing forms. It doesn't seem like it'll be something that is horribly technical. I just think that it'll be a nice administrative burden assessed on small business owners. And if you're thinking, what's the big deal? Do I really have to do this? There are fines that they've put in place for people that don't file. So please talk to us about filing, because it is likely that the cost of us doing it on your behalf will be less than if you just choose not to do it at all. So contact HK if you want help with this. It's something that we'll be likely picking up in the summer for our existing clients, existing businesses, since we have quite a while to get all this registered. But for new businesses as well, if you're registering, feel free to talk to us about it.
And we'll be reaching out to clients as well when we have more information. Right now, the information we do have is a little tenuous, so when we know what HKA's process is, what the process for registering your business is, we'll send out some emails to give people an idea of what's going on and when we can start helping them.
Great. Catherine, any questions as we wrap up our webinar?
We don't have any questions.
Excellent. Well, I want to thank everyone for joining us. We will be posting this recording, so if you need to add a little spice to your holidays, topics of conversation for the dinner table, please feel free to find this on YouTube. Yes.
And we'll also link to it on our social media platform.